there are reasons for optimism. If you look at fall of 24, when 10-year treasuries were, call it, high 3s to 4%, we saw a really nice run of follow-on equity. And I would say that was very broad-based. You had office REITs, you had mall REITs, you had healthcare REITs and the net lease REITs. But that felt really optimistic in terms of being able to grow and a feeling that valuations had gotten to a place where management teams and boards could think about growing again. So I'm optimistic on what that means for valuations. I would say balance sheets are in really good shape. Spreads are at all-time tights in most cases. And so that feels really good, but it does suggest that free cash flow and so forth should continue to grow. And I think that's a harbinger of positive things for the REIT sector.
So, Stephan, how are current market conditions shaping REITs' access to capital and their ability to fund acquisitions, development, or balance sheet restructuring?
So look, that's a great question. And I would say the REIT market is quite broad these days and grown tremendously over the last 20, 30 years. And so if you take the first part of that question around access to capital, and I would sort of connotate that around accretive access to capital, the reality is if you look broadly, persistent NAV discounts are really making that challenging. There are a few, I would say, bright areas in the broader REIT market, like net lease and senior housing, that have been able to access capital and certainly equity capital accretively to fund acquisitions and growth. I would say if you look more broadly across the broader landscape, it's been a lot more challenging to do that. And so REITs are really going through their capital alternatives playbook, whether that be buybacks, which you've seen in office and retail. You've seen PIPEs, one of which led to as a catalyst for an M&A transaction in the industrial sector. You have seen JVs and certainly JV dialogue really pick up. And then I would say the last piece of that is really capital recycling. And it turns out in most cases, because we have this public-private market dynamic and bidding tents are quite strong, for individual assets, that tends to be the cheapest and best source of equity capital, certainly that we're seeing in the REIT sector right now. And so I think it's really specific to a given situation or REIT. Broadly, I think it's been challenged, but there are bright spots, and most REIT management teams are really working through their capital alternatives and making the right decisions for their shareholders.
How does BMO currently view the interest rate environment's impact on REIT valuations, and which subsectors appear best positioned over the next 12 to 24 months?
Yeah, look, great question. Obviously, interest rates are topic du jour on the news, and whether it's mainstream media or the financial media. And I would say, look, if you take a baseline, pretty much this week, pricing in a 95% chance of a 25 bip rate cut. If you take BMO rate strategist economics, that suggests another 4 in 26, which would put SOFR kind of in that mid-high 2s range, which, again, I think is healthy, but I think as we found out, it doesn't necessarily mean that fixed rates and treasuries will follow in kind. Certainly SOFR has been coming down and treasuries have expanded a little bit. But there are reasons for optimism. If you look at fall of 24, when 10-year treasuries were, call it, high 3s to 4%, we saw a really nice run of follow-on equity. And I would say that was very broad-based. You had office REITs, you had mall REITs, you had healthcare REITs and the net lease REITs. But that felt really optimistic in terms of being able to grow and a feeling that valuations had gotten to a place where management teams and boards could think about growing again. So I'm optimistic on what that means for valuations. I would say balance sheets are in really good shape. Spreads are at all-time tights in most cases. And so that feels really good, but it does suggest that free cash flow and so forth should continue to grow. And I think that's a harbinger of positive things for the REIT sector. The flip side is what I talked about earlier on the public-private dynamic. It also means that bidding tents from private buyers will be much more robust and I think much more competitive. So if REIT valuations don't improve, I think it's going to be a challenge for them to grow, certainly on the external side. And I would say it probably also makes take-privates more underwritable. And we've seen a noticeable uptick in I would say, take-privates or certainly sponsors in the M&A market, one of which was announced last night, the retail sector. So net positive, but still some public-private issues to navigate around bidding tents and competitiveness of assets.
And what are you seeing in terms of institutional capital flows and their impact on overall demand for real estate assets and REIT pricing and performance?
Yeah, so look, this is a phenomenal question for a variety of reasons. One, again, this whole public-private dynamic. And so I think about institutional capital flows in 3 sort of areas. And so the first is institutional capital flows into the public REIT sector. And so if you look at that, and empirically, if you look at the history of the REIT market, the valuation dynamic, and when REITs do well, the generalists are really playing and pushing hard into the REIT sector. And I think right now, given the relative value of things like the Mag 7, AI, the better trade has been for the generalists to go that route, sort of a 10 times multiple on their capital versus just being in the REITs. And so I think until that flips, I think it's going to be challenging for the REIT market to catch a bid. Having said that, there is a lot more dialogue and discourse right now on the amount of underweight that the REIT sector is, and I think that's positive because it's getting people's attention, and I'm hopeful that leads to an increase in share prices. Certainly that's something that's much needed when you think about the NAV discounts I talked about earlier. The second thing I would say is private equity dry powder is, if it's not at all-time highs, it's pretty close to all-time highs, and the only reason it's not at all-time highs is because there has been some transaction flow and there has been some investing. And so when you see the play through there, again, they're 70+% of the M&A market last year in REIT land, over 50% this year. And so I think when you think about catalysts for valuation, the private equity bid for assets, and namely take privates, hopefully is a catalyst for REIT valuations going forward. And then the third piece, which I think is also really interesting for REITs, and what I mean by that is it's become more broad-based than it ever was, which is direct institutional capital into real estate, and think pension funds and sovereign wealth funds and the like, insurance companies. What's interesting is they have a voracious appetite for real estate assets right now. And I would say there's two fundamental changes that have happened versus, say, 10, 15, 20 years ago. The first is that they're no longer looking to just be a core investor. So if you're going to approach them around a JV, and again, REIT dialogue is really picked up, it really needs to be something more core plus value add, something that they can't just buy on the screen or get from their debt portfolio. And the second thing is they're moving beyond the four food groups: industrial, apartments, retail, and office, and they're much more focused on emerging asset classes like self-storage, manufactured housing, industrial outdoor storage. And I think that is a great gauge of demand for assets, and hopefully portends a more broad-based rally in asset prices beyond just the four food groups. So I'd say institutional capital flows on the public market remains to be seen if we can flip the script on this underweighting. But the PE and the direct institutional investor are quite positive for asset prices, and hopefully a harbinger for positive REIT momentum.